Welcome to this Thursday edition of FreightWaves Now. I'm your host Anthony Smith, and coming up, Luke Falasca is going to give us a broker update. I'll be stepping in for a little bit of a shipper econ update, but first we're going to go to Zach Strickland with a carrier update brought to you by PowerFleet. Stay tuned.
Hey everyone, and welcome to your Thursday carrier update presented by PowerFleet. I'm Zach Strickland, and today we continue to see volumes slide on down. We were at 8,700 yesterday, now we're down to 8,546 on the outbound tender volume index. That is a 33.85% drop from peak volumes that we saw right up here, almost at 13,000 on the OTVI just a few short weeks ago on March 23rd. So a very rapid drop. We thought we were seeing a little bit of a hesitation here in the outbound tender volume index as it looked like it might be starting to turn. That has changed, and now we are dropping again about as fast as we were before, just in the last day or so. So again, we may not have seen the bottom just yet. We did have a little bit of hope there for a minute, but it looks like things are starting to slide back on down. So we will continue to watch volumes moving forward. So looking at the map, where are the volumes dropping in the United States? Well, pretty much everywhere, but some areas are falling faster than others. Now those in the red here and the outbound tender volume, the volatility map, in the brighter reds, you're gonna see the stronger decreases in volume. Statistically speaking, and then you're going to have moderate decreases in the darker shade of red here. Anything in a green, you're going to see a little bit of an increase. Now this is somewhat surprising, but again, most of these markets are going to be some of your smaller markets down here around San Antonio and up here in Montana. Of course, not a lot of volume there in general, so it's not an absolute volume increase. This is just a statistically significant amount of volume increase for that market in particular. So don't get your hopes up and flood Montana with your trucks thinking that there's going to be a big pile of freight waiting up there. But up here around Minneapolis, Duluth market showing a little bit of an upswing. Again, not a huge market in itself, but it does have at least a trending upward impact. Now, something that's fascinating to me is that if you look over here on this, the volatility map, is that you have a lot of reds, a handful of greens sitting over here in the head haul index, but then looking at the lead time volatility. Now lead time, of course, is the measure of days between a tender and pickup date request. So as this increases, it tends to be a little bit better for a carrier to manage, be able to plan a little bit further ahead, and shippers apparently have been increasing their lead times pretty significantly. This is the outbound tender lead time chart, I should say, for the United States, and you can see the averages actually before all this corona business had been trending higher since about November. And then they kind of were starting to smooth back out, and then of course coronavirus outbreak happened in early March, and we have tracked tender lead times increasing significantly since about the end of March. So really, as volumes were starting to come down, lead times were increasing more rapidly. They were trending up higher. Now, what does this mean in particular? It just means that carriers are probably going to have a lot more visibility into planning their day, or a few days out in the future. So we're almost at 3 days tender lead time, and this time last year we were roughly around a 2.5 day tender lead time. So that's going to give these guys a little bit more heads up. A 12.5% increase year over year in lead time interaction. So what's it doing for capacity? You would think with increased lead times, you would have a little bit more headway into visibility into the market, looking at planning your day. Capacity should fall, and it is, of course, falling. And that's not necessarily due to lead times altogether, but that's volumes dropping pretty rapidly. I pulled up the biggest hub markets in the United States for outbound tender rejection rates right here. Again, measures of capacity, carrier willingness to accept their electronic tenders. You hear it in the yellow, that's our Harrisburg market right there. That's the one that showed a tremendous amount of volatility as the coronavirus initial outbreak was occurring. Leading the pack here, still at a 5.69%. That blue mountain there in the background, that is the national average, where we were sitting about 4.19% on outbound tender rejection rates. So they continue to drop pretty rapidly, but there is a little bit of smoothing in this curve. You're looking at the Atlanta, Ontario, Joliet, Dallas markets are all showing a similar kind of flattening here as we enter the middle of April. So capacity may be finding a bottom in itself. And that'll do it for today's carrier update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Hi, good morning everyone. I'm Luke Falasca bringing you another broker update. It looks like volume levels are continuing to slide, but not quite everywhere. Obviously, not every market is equal. We'll take a look at that. For right now, we've got the volume level in blue. Remember, this number was sitting right around the 87.50 yesterday, so it's continuing to fall. It fell about 200 points. So that's continuing to slide. It looks like it picked up speed. We'll see if that continues. Ultimately, time will tell to see how low it goes. A lot of that's going to be driven by consumer spending. So if that continues to slow down, which it has obviously, then that number could continue to slide further. The green line is tender rejections. Those are obviously also continuing to slide. Dropped about 0.4% yesterday. So now we're down to about 4.2%. Now that number may break 4%. I wouldn't be surprised if it does. It's continuing to drop, which means capacity is continuing to loosen and spot market rates are continuing to drop. Now let's take a look at the map here. Now something yesterday I want to draw your attention to. If you remember from yesterday, we were looking, this map is the dry van weekly volume change, so over the last 7 days. Now the markets in blue are where the markets are growing, the red and white markets are where volume levels are contracting. Yesterday, we looked at Austin, Texas, right down here, and that saw about a 40% increase in volume levels as of yesterday over the last 7 days. And today, it's not seeing any increases. Just like that, a market can change. So we want to keep an eye on that, and you'll notice here, there's been a lot of changes just in a single day to the markets, right? Obviously, there's still a lot of red, a lot of whites, there's a lot of volume levels continuing to decrease, but there are some areas of opportunity there in blue. Fort Worth, right here, right next to Austin, Texas, is seeing some growth in volume levels. Up here in Minneapolis, seeing significant growth as well. We didn't have that yesterday. Yesterday, that market was still contracting, but today it's finally starting to pick up a little bit of pace. Now, this isn't to say that these volume levels are necessarily high. All it's saying is that these volume levels are beginning to increase again. So that's a very good sign. So if you're looking for areas for short-term opportunity, I'd focus down here around Fort Worth, also Minneapolis. Those are going to be some of your bigger regions that are seeing increases. Also down here south, right out of Atlanta, you've got Macon, Georgia, seeing a little bit of increases. Always a good place to look outside of Atlanta for some opportunities. And also seeing a little bit of opportunity here in northern Florida. So keep an eye on those areas, potentially focus on some calls in those areas for some opportunities. Now, we're going to take a look at Minneapolis. There's a handful of things going on here. The market, the blue line is the volume level. You'll notice it's pretty choppy. We didn't really have that massive surge in outbound volume out of Minneapolis like we've had in other markets. A couple dips, it was a little bit higher, but a lot of markets saw this massive surge, like 30, 40% surge in some areas. We didn't have that in Minneapolis on the outbound side. Now, this orange line here is those tender rejections out of Minneapolis. Look at how volatile they are. They've gone, I mean, here at the peak, those did rise, and those got up to about 24% there, give or take. Then they dropped, came back up, and now we've dropped again, and we're sitting at about 11.5%. And we've seen a little bit of a dip there. So it's surprising that tender rejections are holding up so well in Minneapolis when volume levels have really just fallen off of a cliff. I mean, they didn't really rise that much, but they've certainly fallen, and fallen quite heavily, over 25% there from that high. So now the reason why it's starting to rise again, it's a good place to look at the inbound volume. So let's go ahead and look at that. Right here, what we have is in blue, you've got the outbound volume out of Minneapolis, and then in green, you have the inbound volume going into Minneapolis. So yes, the outbound volume in blue is falling, but what's interesting is the inbound volume, which was way up here, is falling at a much faster rate. The inbound volume to Minneapolis is down 50% over the last 2 weeks, and the outbound volume is only down 25%. So there's going to be a capacity crunch out of Minneapolis. So keep an eye on that. Shippers will have a harder time covering freight. I'm Luke, and that'll do it for today's broker update.
Voices from every corner of the supply chain concerning all modes of transportation. From the world's largest logistics podcast network, this is what the freight tech revolution sounds like. Freightcast presented by FreightWaves. Subscribe now wherever you get your podcasts.
Welcome to Shipper Update. I'm Anthony Smith, your host and your economist. Today we're going to look at some of the latest numbers from the macroeconomy, covering the latest numbers for March. And so one of the areas that we were looking at very closely and we're really expecting to see a lot of decline was going to be manufacturing. We got the latest numbers from industrial production, and needless to say, they're not good. So what we have here in the purple line is flatbed outbound tender rejections, of course, our proprietary data set that gets updated on a daily basis. And in the green line, we have industrial production. And we can see in this green line that there was an absolute just steep decline. This was a 5.4% month-to-month decline. On a year-over-year basis, this was also, again, a 5.5% drop. This is the steepest drop we've ever seen since, I think, since the 1940s, really. And so when we look at industrial production, just over 70%, somewhere around 70-75% is going to be made up of manufacturing. And this is going to be one of the hardest hit areas, as we were mentioning on previous episodes of FreightWaves Now. And then, so what we can really see is this being one of the areas that's really going to damper and put a big weight on capacity, on the lack of capacity for flatbed. So there's going to be a lot of capacity on flatbed just because there's such a drop in manufacturing. The other part of industrial production is going to be mining, and that's also really getting hit hard. So when we're looking at industrial production, it's definitely going to be one of the hardest hit areas. Also, a lot of talk around when the economy is going to open back up again. Manufacturing is likely going to be one of the areas that's going to be looked to between manufacturing and construction. One of the two areas that are going to be looked at to kickstart the economy again. But what we're looking at manufacturing, this is one of the areas that was hit hard before the coronavirus ramp up. And so we saw was that there was a lack of business investment. And that business investment is likely going to be a lot really hampered by the uncertainties from the coronavirus, as it was hampered by the uncertainties around trade wars. And so we're looking at industrial production, there's likely going to be some kind of stimulus or some type of incentivization in order to kickstart manufacturing again, so businesses start to feel a little bit more confident in investing. Next up, we have retail sales, and we can see yet again a complete drop in retail sales here. We're looking at the year-over-year growth. This is a 6.2% decline on a year-over-year basis. This didn't come as too much of a shock. I think the biggest surprise was how much food, beverages, and grocery store panic buying was going to kind of pull up results. And so what we can see here, one of the hardest hit areas, of course, and the next slide looks very similar to the overall trend, is retail sales for department stores. These are one of the areas that was going to be hardest hit because this is one of the consumer-facing segments where you actually be in store. And what we can see is that there was over a 20% decline year over year. And so this is going to be one of the hardest hit areas as well when we're looking at consumer-facing trends. On the flip side, when we're looking at food and beverages, grocery stores, of course, we see nearly a 30% rise on a year-over-year basis. This is expected after we saw a lot of the ramp up and panic buying from grocery stores and outlets like that. But this is not likely to last because, of course, the latest numbers that we've seen in the headlines, weekly jobless claims. And so latest number for weekly jobless claims saw that there was another increase of 5.2 million. Now, when we're looking at weekly jobless claims, it looks like it's starting to decline. But the thing here is that these are new applications. It's not like this is a weakening of sorts. It is starting to come down, but there's still another 5 million that's applied. So that means over the last few weeks, there have been over 20 million applicants for initial jobless claims. And so this is going to be one of the areas that's really going to hamper a lot of that panic buying that we saw early on, and really a lot of the economic spending, despite a lot of the stimulus package talks and distributions going on right now. Thank you so much for tuning in. That's going to do for this Econ Shipper Update. The content doesn't stop here. We're always streaming around the clock. So check us out on all your favorite streaming platforms, including Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.